All right, we're going to try to finish up chapter 5 of this video here. Let's get back into it. Converting personal use property to business use. So your basis for business purposes, it's going to be the lower of the fair market value on the date of conversion or the owner's adjusted basis on date of conversion. I've got a vehicle that I purchased for $5,000. It's now appreciated, very rare, to $10,000. I can't put that into a business and then claim depreciation expense of 10,000. It's got to be 5,000 because otherwise it would be really easy to take advantage of the IRS and the tax law system if I could just use a higher fair market value for business purposes. So this is to stop people from trying to take advantage of the tax system. And if the fair market value is less than the donor's basis of the conversion, then you get fair market value less your depreciation taken. That's going to be used to calculate your loss, or the owner's adjusted basis on the date of conversion to calculate the gain. So allocation of basket purchases. Basket purchases are, I buy a plethora of stuff for $100,000. Well, what's the price of each individual item? I don't know. I bought it all for 100,000. This goes through calculation. So determining the total purchase price plus the cost and outlays for placing the items in service. Determine the fair market value of each asset purchase. You may have to obtain valuation from an expert. We're accountants, we're good with books. I couldn't tell you how much a piece of equipment or machinery with 3 years of activity on it costs. I have no idea, right? I can tell you what your basis is, looking at depreciation, initial purchase price, sales tax, insurance, delivery, all that. But how much is this fair market value worth now? I don't know. I got to go to an expert to get that. And then step 3, you multiply the amount from step 1 by each asset's proportionate amount of fair market value. That's going to be your components asset basis, right? So I've got, and let's just make this simple. I've got $100,000 and I buy 10 things. Each one is going to be, and they all have the same fair market value. Let's say each of them is worth $10,000. Allocation of basis. So if multiple assets are acquired for a single purchase price, then the acquisition costs are allocated to individual assets on the basis of the fair market value. Here we got 3 X-ray machines. They're purchased for 11,000, 13,000, 16,000. Total installation delivery cost 5,000. What's the total basis of each X-ray machine? So here we've got 11, 13, 16. That's going to be a total of 40,000. So if I take the first one, I'm going to divide it by the cost of all of them. Yeah, 0.275. So that's that share of the whole. We multiply that by 5,000. So I have additional basis of 1375. And this next slide is going to go over that. I just want you to see how it plays out. Yeah, and then you do it for the other two, and then you have adjusted basis. Non-taxable stock dividends. They'll be allocated a portion of the basis from which the stock upon which the dividend was issued. And your new basis per share is going to be total basis divided by the number of shares now owned by the taxpayer. If your fair market value rights for less than 15% of the fair market value stock, then your basis of rights is 0. If it's greater or equal to, then the basis has to be allocated between the rights and the stock. Here we've got more on this. If rights expired before being used, the basis is reallocated back to the stock. If rights are exercised, the basis of rights gets added to the cost basis of the stock. And if you sell your rights, then the basis is used to determine the gain. Property transactions. This is where it starts to get kind of fun. Netting short-term, long-term, figuring out the holding periods based off property. The sale or exchange of capital assets will result in capital gain or loss for each asset. straightforward. Then the transaction must be categorized as short-term or long-term, depending on how long the taxpayer has held the property. We went over this. Short-term is less than or equal to 1 year, and long-term is greater. How is it taxed? Taxpayers can go through a netting process to derive an overall long or short-term capital gain. Long-term capital gains, tax favorable rates, cover that in the earlier video. Short-term capital gains, it's ordinary tax rate. And then you net that out and you're limited to a $3,000 deduction per year. I can't sell something at a loss of $100,000 and claim a $100,000 loss. It's got to be $3,000 for each, which would take a long time to use that up, 34 years, but that's the way that plays out. And we already looked at that slide. I'm not going to go too far into this because this isn't the point of the class. I just want you to know if there are other items that get taxed and treated differently. Unrecaptured section 1250 gain, collectibles, section 1202 qualified small business stock. We're going to assume that all capital gains and losses aren't these. You don't see these all that often. I think in the 6 years of doing tax returns, I haven't seen anyone sell collectibles. You just don't see them that often. So it's good to know that it's different, but don't expect to see it. I'm not going to go too far into this because we already said that this isn't part of it. Okay, so netting the realized capital gains. So step one, net gain or loss by short-term or long-term. So what's my gain? What's my loss? Is it long or short-term? You combine your short-term capital losses with your short-term capital gains, and now that's my net. Depending on where I fall, it could be a gain, could be a loss once I combine them. You do the same thing with long-term. And then you combine your results in the following manner. Combine any net short-term capital gains with any net long-term capital losses. You combine any net short-term capital losses with any long-term gains. If both are gains, then you apply the appropriate tax rate. If I had 20,000 in long-term capital gains and 50,000 in short-term capital gains, well, okay, this 20 is going to be taxed at 20% or whatever bracket. And the 50 is going to be taxed at my ordinary rate. If one's a loss and the other one's a gain, then you have to net them, and then whichever is greater determines your result. If the short-term capital losses are greater than the long-term capital gains, you deduct $3,000 of loss against the current year's income. Rough is carried forward status of net short-term capital loss. And if your long-term capital gains are greater, then you recognize it current. And if both are losses, then you say, okay, my net short-term capital gains are first to offset, and then I go. But net usually, or short-term typically comes first. It has less value to a taxpayer as opposed to long-term, and so that gets used up first. I'm not going to go into this. A good slide to print out. Kind of goes into what I just described here, but in a flowchart form, which is probably easier to understand. Holding periods, I'm not going to get too far into this because we've already harped on it quite a bit. Exceptions, gifts, and bequests, we kind of went into that. Non-taxable exchanges, section 1031. That's if I have a piece of property, let's say I've got this building that I purchased for $100,000, and this guy over here has a building that I want. I can trade with him, and that's not a taxable. It's just if you were to include boot, which is what they call it, which is, let's say I trade my building for his building, and he gives me $20,000 in cash. The cash would be considered boot, and that would be taxable. But just the exchange of property is. Property received from deceased, that's always going to be long-term, 100% of the time. Compliance and procedural considerations, capital gains and losses are reported by individuals on your Schedule D. To improve taxpayer compliance, every broker is required to furnish the government with information pertaining to each customer. That gets reported to the taxpayer on Form 1099-B. That's going to be a summary of everything in this client taxpayer's brokerage account. And then you have to use Schedule D to reconcile the amounts shown on 1099-B. So the 1099-B is going to have, hey, here's your ordinary dividends, here's your qualified dividends, here's your capital gains. You have to go in there and put it like, okay, yep, here's my ordinary dividends, here's my qualified dividends. And if the brokerage has it, and a lot of the times they do, what you originally purchased it for. Hey, you know what? This guy purchased Microsoft stock 20 years ago and he bought it for this amount. A lot of the times they have that. If someone jumps between brokerages, I'm at Fidelity, and then I go to Robinhood, and I transfer stuff over, and I said, you know what, actually, I want to have it at Principal. A lot of the times that can get lost in the shuffle. And that's why you want to document your basis and show how you got there. Worthless securities, section 165. Sale or exchange has occurred in the year that a security that was a capital asset becomes worthless. You may realize and perhaps recognize a loss for the amount, since the amount you're going to get for it is zero. So that makes up chapter 5. A lot of information here and a lot of rules depending on what's the order of events. Was I gifted this property? Did I inherit this property? What's the fair market value of this property? When it was donated to me, what is it now? Did I sell it? There's a lot of different rules. I would recommend, especially for probably a chapter like this, read the chapter in the book. It's going to cover it in a lot greater detail than I can do with these videos. And there's a lot that can go into it. It's not as simple as I bought this thing and then I sold it and now I have a gain. It can get very complicated very quickly. Okay, so that is chapter 5. Thank you all